Understanding today's precious metals market, what investors need to know. If you've been tracking gold and silver lately, you might be wondering why things feel so quiet. After weeks of extreme price swings that had traders glued to their screens, today's modest declines, gold around $5,069 and silver near $81.75, might seem anticlimactic. But here's what experienced market watchers understand. The absence of drama doesn't mean the absence of opportunity. Before we dive in, drop a comment letting me know where you're watching from and today's date. Market conditions evolve rapidly, and understanding the timestamp on this analysis helps both of us track how these predictions unfold, why today's stability is deceiving. The precious metals complex is displaying what I call loaded spring behavior. Yes, prices are drifting slightly lower in today's session. No, we're not seeing the violent 4% daily moves that characterized last week's action. But this compression matters more than the recent expansion. Think of it this way. Markets operate in cycles of volatility and consolidation. After extreme moves, assets need time to digest, reassess, and prepare for the next directional thrust. We're in that digestion phase right now. The question isn't whether another significant move is coming, it's when and in which direction. Two critical data releases loom on the immediate horizon that will likely break this consolidation: Wednesday's employment report and the upcoming inflation numbers. These aren't just routine economic updates, they're catalysts that will reshape Federal Reserve policy expectations, dollar strength, and, by extension, precious metals valuations. Consider the employment picture. Robust job creation suggests economic resilience, reducing pressure on the Fed to cut interest rates aggressively. Disappointing numbers do the opposite, potentially accelerating the timeline for easier monetary policy. Since precious metals typically move inversely to real interest rates and the dollar's strength, these data points carry enormous weight. The inflation story is equally critical. We've experienced years of back-and-forth scorching price growth, cooling trends, and frustrating stalls. Current readings place us in ambiguous territory. Has the inflation dragon been slayed, or are we simply in another temporary lull? This week's data will provide crucial clues about the answer, so when you observe metals trading sideways or slightly lower ahead of major data, recognize it for what it is: strategic positioning. Sophisticated market participants aren't making aggressive bets right now. They're waiting for clarity. There's wisdom in patience. En Briand, the dollar's global competition heats up. While short-term price action captures headlines, a structural shift with massive long-term implications is unfolding. China has instructed its financial institutions to reduce exposure to U.S. Treasury bonds. This development deserves your attention. For years, China has ranked among the world's largest holders of American government debt, helping finance U.S. budget deficits by purchasing billions in Treasury securities. That arrangement benefited both parties until geopolitical fractures made it untenable. Escalating trade disputes, tariff battles, technology competition, and concerns about potential asset freezes, dollar weaponization, have fundamentally altered Beijing's risk assessment. Chinese regulators are now directing banks to decrease Treasury holdings and pursue greater portfolio diversification. The immediate market reaction was telling. The yuan strengthened to approximately 6.9 per dollar, approaching three-year highs. Currency movements of this magnitude signal shifting confidence and capital allocation decisions. But China isn't acting in isolation. We're witnessing a broader, coordinated global trend. Central banks worldwide are accumulating gold at historically elevated rates. Sovereign wealth funds are deliberately reducing dollar concentration. Alternative payment and settlement systems are being constructed specifically to operate outside dollar-based infrastructure. When President Xi speaks publicly about creating a powerful currency, dismiss it as political theater at your peril. These statements reflect genuine strategic ambitions to reduce dependence on the dollar's global dominance. Here's the connection to your portfolio. Surface-level price movements may show gold down 10 on any given day, appearing insignificant. But beneath that surface, the foundational architecture of international finance is being remodeled. Those tectonic shifts will drive precious metals demand for years, regardless of this week's employment report. Political theater meets economic reality. Recent political developments add another layer of complexity to the Fed's already challenging mandate. President Trump's public statement that Fed Chair nominee Kevin Warsh could deliver 15% GDP growth deserves examination, not for political scoring, but for market implications. Context matters here. U.S. economic growth has averaged roughly 2–3% annually for decades. Exceptional years might touch 4%, but 15%? That figure bears no relationship to historical performance, structural productivity capacity, or demographic realities. It's not an economic forecast, it's aspirational rhetoric disconnected from constraints. I'm not critiquing political messaging, I'm analyzing what unrealistic expectations mean for markets and monetary policy. The answer? Immense pressure. Pressure to deliver outcomes that cannot be achieved through interest rate adjustments and liquidity provision alone. The Federal Reserve influences financial conditions. It doesn't directly control GDP growth at those magnitudes. When unrealistic expectations inevitably collide with actual results, what follows? Disappointment, finger-pointing, policy unpredictability, and crucially for our purposes, heightened uncertainty that typically benefits safe haven assets. Additionally, public criticism of former Fed Chair Powell as a big mistake carries implications beyond personal disagreement. Such rhetoric erodes confidence in Federal Reserve independence, the bedrock principle that monetary policy operates on economic data rather than political pressure. Markets function more efficiently when central bank credibility remains intact. When that credibility appears compromised, when monetary policy seems vulnerable to political influence, faith in currency management deteriorates. And when institutional confidence erodes, investors seek alternatives. They gravitate toward stores of value that transcend political cycles. They turn to gold and silver, assets that have preserved purchasing power across millennia, regardless of which government or political faction held temporary power. Processing recent trauma. The past 2 weeks inflicted psychological damage on precious metals investors. Commerce Bank's analysis captured the extremes. Gold surged nearly 4% one Friday after falling by a similar magnitude the previous day. Silver rocketed 10% higher following sharp weekly losses. Intraday ranges exceeded $400 for gold and approached $20 for silver. These aren't ordinary market conditions. They fracture confidence and force even experienced investors to question their positioning and risk management. The evidence appears in fund flows. Gold ETFs experienced approximately 20 tons of outflows last week, the first weekly decline in 5 weeks and the largest since late October. When institutional and retail money exits exchange-traded products, it signals nervous investors locking in profits and reducing exposure. Silver presented a more nuanced picture. Weekly net inflows of 700 tons superficially appear bullish. However, the timing reveals the real story. Nearly 1,000 tons flooded in early in the week before volatility struck. Then came the reversals and outflows. That pattern indicates investors caught on the wrong side of violent moves. Most dramatically, a Chinese silver fund was forced to halt trading for an hour on Friday. When trading resumed, the fund crashed by the maximum allowable 10% daily limit. That's not orderly price discovery. That's panic. The current consolidation partly reflects recovery from recent trauma. The market is recalibrating, attempting to determine whether volatility has peaked or merely paused. My honest assessment? We're likely not finished. The catalysts that created recent turbulence haven't disappeared. They've simply gone quiet temporarily. Navigating what's next. We're heading into a data-heavy period with jobs numbers, inflation reports, ongoing geopolitical tensions, China's strategic dollar diversification, and political pressure on Fed independence, all converging simultaneously. Any single factor could trigger the next significant move. Combined, they create conditions where substantial price swings aren't merely possible, they're probable. Where markets settle reveals who controlled the session. The bottom line, current conditions are practically engineered to induce investor mistakes. Volatility destroys confidence. Headlines whipsaw between euphoria and doom. The temptation to act, trade, adjust positions, chase momentum becomes overwhelming. But sometimes the optimal move is no move at all, particularly for long-term investors with sound fundamental theses. A single jobs report won't invalidate the structural drivers: mining supply constraints, relentless central bank buying, ongoing currency debasement, and geopolitical hedging demand. Those factors remain operational. Today's market may be quiet, but that silence is temporary. Data is coming. Volatility will return. Your positioning right now determines whether you capitalize on the next major move or simply react after the opportunity has passed. Stay disciplined, stay informed, and remember, this is educational analysis, not personalized financial advice. Conduct your own research and understand your risk tolerance before making any investment decisions.